This is an uncovered Japan company research report on Menicon, ticker 7780. Menicon is Japan's original contact lens maker and the domestic leader, with an unusual monthly subscription business. The investment question is whether its new Malaysian daily lens plant can turn a strong home franchise into a higher-margin global growth engine. At the report date, Menicon traded at 19.3 times forward earnings and 1.33 times book value. That looks inexpensive versus the broad precision instrument sector, but roughly fair versus closer medical device and pharma peers. The shares are not simply a cheap multiple story. They are an execution story, with returns and margins still held down by investment that has not yet earned its keep. Menicon clearest differentiator is MELS plan. Instead of relying only on occasional box purchases, members pay a monthly fee and receive replacement lenses through roughly 1,600 affiliated eye care outlets. MELS generated 50.7 billion yen in fiscal 2026 and serves about 1.3 million members. That direct relationship makes revenue more visible and supports price and mix improvements, although member count has drifted down modestly. The product mix makes the strategic priorities clear. Other contact lenses and lens care products remain the large, stable base, while daily disposable lenses are the growth engine, reaching 33.8 billion yen and growing 9.3% in fiscal 2026. Overseas daily disposable sales grew much faster from a small base. Orthokeratology remains strategically important for myopia control, but was held back by a soft Chinese market. Revenue has compounded at 5.8% over 5 years, from 100.2 billion yen in fiscal 2022 to 125.6 billion yen in fiscal 2026. But operating profit remains below the fiscal 2023 peak, leaving the margin at 8.1%. Management guides to 133 billion yen of revenue and an 8.3% operating margin for fiscal 2027, which signals a gradual rather than immediate recovery. The key financial distinction is between cash generation and reported profit. In fiscal 2026, EBITDA rose 14.1% to 21.1 billion yen, while operating profit rose only 2.2%, as depreciation reached 9.7 billion yen and goodwill amortization added further expense. This does not remove the risk, but it explains why the accounting margin is weak, while newly built assets are still waiting for volume. The Malaysian plant is the central swing factor. Menicon invested roughly 50 billion yen in the first phase, with capacity of about 500 million lenses a year, and commercial production began in February 2026. The plant could improve supply and cost competitiveness, but it carries substantial fixed costs. If overseas daily lens demand disappoints, low utilization flows directly through to weak margins. Menicon's balance sheet is sounder than the profit headline alone suggests, with a 48.5% equity ratio. Yet the investment phase has kept free cash flow negative for 4 straight years, including minus 4.6 billion yen in fiscal 2026 after heavy capital spending. The report's base case expects free cash flow to turn positive in fiscal 2027, but that depends on utilization and capex falling as planned. Menicon's Milestone 2027 plan targets 140 billion yen of revenue and an operating margin near 12% by fiscal 2028. Reaching it requires overseas daily disposable sales to grow from 3.75 billion yen in fiscal 2026 to roughly 11.5 billion yen. The earlier version of the same margin target was missed and pushed back, so the report treats this as a concrete goal to monitor rather than an outcome to assume. Peer comparisons frame why the valuation is balanced rather than obviously cheap. Menicon earns a higher margin than domestic rival Seed, but global contact lens leaders operate near 20% margins. Menicon's forward PE is still 19.3 times. If the Malaysian plant moves the margin toward the low teens, that multiple can look justified. If margins stay near 8%, it is harder to defend. The report's scenario analysis is deliberately wide. Its illustrative fiscal 2029 values range from 907 yen in the bear case to 2,371 yen in the base case and 4,052 yen in the bull case. These are not price targets or recommendations. They show that the outcome turns on the same observable variables: Malaysia utilization, overseas daily lens growth, the cost ratio, MELS membership, and whether margins can recover. Menicon combines a distinctive domestic subscription franchise, technical contact lens know-how, and long-term myopia demand tailwinds. The risk is equally clear. A capital-intensive global expansion has to fill a new Malaysian plant and restore margins. For investors, the right approach is not to assume the re-rating, but to track the operational evidence quarter by quarter. This is research, not investment advice. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.